Hello and welcome today to Trading Long Options. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Connie Hill, who's a 20-plus year veteran of the financial markets and has taught this particular class on a number of occasions as well. She's there to help facilitate the conversation. You're there to learn and become engaged in this topic. So thanks for being here, whether you're here with us in the live version or in the recorded version. It doesn't matter. We're glad to have you in either case. If you're in the recorded version, leave us a comment in the comment section. We'll get back to you on that. If you're in the live version, be a part of the conversation. That's what Connie is here to help facilitate, is keeping that conversation going on an ongoing basis. Now, we're going to talk kind of up, down, and maybe some sideways in this discussion today as we talk about long options. Given the fact that implied volatility is up a little bit, but the markets are not necessarily so much. So we'll see how that plays itself out in this discussion of long options. These are some of the elements of consideration that we look at when choosing a long option strategy or a long option candidate. So thanks for joining us. Once again, a couple of quick housekeeping items. Everything we talk about simply for illustrative and educational purposes only, not a recommendation or any kind of advice. Remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Now, we're going to use the Thinkorswim desktop software platform today, specifically the paper money version. It is not a guarantee of future success out there in the real world. The paper money version at least behaves a little bit differently than a live trading account. And those are some of the things you should keep in mind as you move your practice from paper money to live trading. It's a great sandbox, great learning environment, but again, doesn't guarantee that you're going to be successful. In fact, nothing does, except hard work, maybe. Investing involves risk, including the loss principle. Remember that stop orders do not guarantee the execution price of the order, just the activation price. Remember that past performance of any security strategy doesn't guarantee future results or success. So let's pop over here to the Thinkorswim desktop software platform, take a look at what's going on. I'm just going to pop over here to our charts and we'll see what's going on in the market today. Welcome to those of you who've been here before, and certainly, of course, to those of you who are brand new in this discussion. We're glad to have you with us as a brand new attendee. So while I make this transition over to the Thinkorswim desktop software platform, I'm just going to remind you, or tell you for the first time if you're brand new, click on that subscribe button down at the bottom of the page if you have not done so already. That keeps you a part of the conversation. It pops this content up to the top of your YouTube feed as well as others, and it's at no cost to you, but it returns great benefits because you then have easier access to all of our great coaching content. So let's take a look at what's going on in the S&P 500 today. The SPX is really kind of going sideways. We've had 2 days in a row that have been kind of these almost doji cross or doji star type candles where you have equidistant, very small shadows or wicks top and bottom. You have very, very small distance between the open and the close. And to be fair, those candles aren't really conducive to long option trading, because long option trading at its kind of core is a directionally sensitive strategy. We need movement, we need it now, and we need it big. Got to be big, it's got to be big movement, biggest movement you've ever seen. But when we see candles like this, these last couple of days, that's not beneficial necessarily to long options, even options that are trading in a bearish direction. So what do? Well, that's when sometimes it becomes a matter of being patient when it comes to being a long option trader. So we'll talk about patience in this context. Today we're seeing a little bit more bearishness in the NASDAQ as it starts to peel off just a little bit more today. Yesterday was one of those spinning top type candles, or doji cross type candles, or doji star type candles. And today the Russell 2000, maybe the area that we're seeing perhaps a little bit more downside directional potential, not a big reversal, but two things have occurred here. One, the price of the index has broken below this diagonal trend line. That diagonal trend line making up the bottom of kind of an upward moving diagonal channel. So we've had a breakout or a breakdown, if you will, and then a rally back up, because if I were to take that line and I were to just activate that line and I were to kind of draw that back up here, you can see what's happened in this particular case. And I think this is a key kind of technical analysis point. The break of that line, it's rallied back up into that line, and it's now starting to move back down from that. So that's a retest of a previous price channel. Now, if that had broken back up into that price channel, that would be a pretty good confirmation of the consistency and strength of that upward channel. But they did not do that. In fact, it hit that resistance and it bounced down. The other thing that has occurred here in this exact same circumstance in the exact same time frame is this, and I'll just kind of zoom back out so that you can see it a little bit more clearly, is we've had a break and a retest to the downside of the RSI, that relative strength index, again, a momentum indicator. And so we see that break down at the same time, coincident to the break in the support level, rallies back up into kind of that area. Now, obviously, the RSI does not work in the context, because it's not a tradable instrument. It doesn't work in the context of levels of support and resistance, but it has levels. Levels, Jerry. It has levels that it finds and moves within. And so we've seen that rally back up into that level, and then it's bounced back down, consistent with the retest of that resistance area on this chart. So from a technical analysis perspective, you've got a bit of an evening star type of candle pattern setting itself up here. The evening star, in poetic Japanese candlestick terms, indicates the sunset of an uptrend and the beginning, perhaps, of a new downtrend. Now, that doesn't guarantee that it's going to move in a downward trend. It doesn't mean that it's reversing. It just means we're seeing some downward pressure. But once again, this is a little bit more directionality than we've seen in the other two indexes. So we're going to look for something here within the small caps, the Russell 2000, that gives us an opportunity to trade maybe a little bit more directionally to the downside. So let's go there. Let's take a look. I've got a watch list in this particular case. I've got a watch list called Small Caps. Let's see where that is. Small Cap Weekly Options. And this is a dynamic watch list. So what this is a watch list based on a scan. It's looking for stocks within the small cap index that exist within the S&P or the Russell 2000. So these are going to be smaller market capitalization names. And then it's looking for whether or not the price of that index, or excuse me, the price of that individual stock within that index has been moving down or up and is giving us either a hold, a close above the high of the low day, or a breakout or a breakdown. So we've got a couple that are doing that. Now, the other indicator that I added onto this watch list was current implied volatility percentile. So why would I want to know that? Well, if I were seeing a number of different positions or a number of different opportunities here that were breaking out or breaking down, and I had a way to choose between one or the other, one way that I could go about choosing would be from a function of implied volatility percentile. Because that implied volatility percentile, if we're looking for a long option trade, whether it's a call option or a put option, we're looking for a long option trade, we're looking for that opportunity to take advantage of low implied volatility, then potentially rising. So we want to kind of sort that if we were looking at a comparison one versus the other. So the one that I'm looking at now from a bearish perspective is this one, Shake Shack. And it's breaking down today below a support level. It's also got an implied volatility percentile number about 32, the 32nd percentile, which is not high. We would consider 50% to be the midpoint. So above 50% would be higher. Below 50% would be below the midpoint. So 30% would be lower. And low implied volatility oftentimes rises, especially if the price starts to go down. So we're going to look at this one. We're going to look at Shake Shack. So let's do this. Let's go over to our charts. Now, one other chart I wanted to look at really quickly before we go to that Shake Shack chart is this one, and that is the VIX grid, just to kind of get a sense of what our VIX is doing today. So VIX gapped up a little bit, but it's kind of sitting there. So it's just a little bit higher, but it's not hugely higher. And that's indicative of what the SPX is doing, just kind of sitting there. There's not a lot of fear, despite the fact that we're on the eve of potentially a government shutdown, but that doesn't typically tend to move the market. It tends to spook the market, but it's not really spooking the market here at this particular point. But could it? Yeah. Could we see the VIX spike pretty quickly? Yes. I think if we were to come to the point where we actually have a government shutdown, I think we would see the VIX spike a little bit, not significantly, but I think it would spike just a little bit. So let's kind of keep that in mind. That's something to pay attention to, something to watch. So let's go back to our charts. Let's go to our single chart grid, which is the kind of playground that I like to use, just this little sandbox. And we're going to take a look at one, which is SHAK, Shake Shack. And you can see that Shake Shack, in terms of the trend, has generally in the intermediate term time frame been moving down. We had this symmetrical triangle, or kind of a descending triangle almost. We could even call that maybe a rising wedge, and it's broken out of that rising wedge, and it's now sitting at a support level. Now, if I were to draw that line where that support level is, we're kind of drawing this along this level right here, around 92. That's the support level that we're seeing. But you see how that's kind of echoing what the Russell 2000 was doing, kind of rallying back up and then bouncing down and kind of sitting at that support level. Now, the Russell 2000 is kind of broken already, but Shake Shack just kind of sitting here. We're past National Cheeseburger Day. By the way, I posted about National Cheeseburger Day last week. And Shake Shack was one of the symbols that I included in that discussion. I did that on X. You can follow me on X at Ben Watson CS. You can follow Connie on X at Connie Hill CS on X. We'd love to have you follow us over there. But my expectation here is that we see a downward move. Now, not all the way to zero. The likelihood of Shake Shack going to zero is probably pretty low. Not zero chance that it would go to zero, but it's a pretty low probability that it's going to move to zero. So I'm going to look for something like this. I'm going to look for this move maybe down to that 74 mark. So here's the thing in terms of managing this trade. I want to get out of this trade if it starts to go against me. Now, normally, I would not put a stop order on a long option trade. We talked about that. We had a conversation the last time I taught this class about not stopping those out. But we're going to do something a little bit different here because we could get a bounce. We're at a support level. Now, the support means there's a possibility of buyers stepping in and pushing price higher. So I want to be able to exit this position if this starts to move against me. But I'm not going to do it based on the price of the option. I'm going to do it on the price of the stock. So we'll see what that looks like. And so we're going to also exit this position if it goes down on the price of the stock. So we're going to look at a long put option in this particular case. We're going to buy enough time to let this trade do what it's going to do, or what we would like it to do. No guarantees. But we're also going to hopefully take advantage of a rise in implied volatility. So I'm going to go to the trade tab. And I'm going to look at Shake Shack here. And again, here's that 52-week or current implied volatility percentile, about the 32nd percentile. And I'm going to come over here and I'm going to go out enough time to let this trade do what it might do. And that is, I'm actually going to go out here to the 19 December expiration. Notice I'm beyond the weeklies. This is not a hugely liquid underlying stock, but it's pretty decent when it comes to liquidity. We'll see what the bid-ask spreads look like. But I'm going to go out to the 19 December expiration. And these are not hugely wide. They're wider. But we're going to go out that far. And my expectation is that I want to see this price continue to move to the downside. But I still want to buy a fair amount of intrinsic value, something of value that if time decay goes away, time decay eats away at extrinsic, that I've still got something. So I want a little bit of leverage here. So I'm going to look right around The 105 strike, maybe the 100 strike, that has a 40-cent wide bid-ask spread. I'm okay with that, right? I'm okay with that. And that's about a 60-cent delta in this particular case. And it's got about 5 cents of theta and about 17 cents of implied volatility sensitivity, or vega. So those are their expectations. Now, here's the thing. If I look at the implied volatility for this option, 19 December, and I go over here to the right-hand side, 53% implied volatility, and I look at the expected move based on that, that's about 20. I'm going to just round this to $20. And we're going to go back over here to the chart. And I'm going to say, look, if we're at 92, so I'm just going to grab my calculator here. 92 minus $20 puts us at about 72. Oh, interesting. That's just about where that support level is that we've drawn in there already. In fact, it's slightly inside that, or actually slightly outside that range. So where we've put that target, it kind of falls within that range. But what I also know is generally the option market kind of over exuberance tends to over exaggerate this number a little bit. This $19 move is probably more realistically going to be maybe 5% less than that, maybe 2% less than that, just in general. So that's okay. I mean, that puts us kind of right around that 74 level that we saw, that we drew on the chart as an exit point. And so that's, again, that suggested move. But that assumes also holding this all the way through till expiration, which we're probably not going to do because we want to get out of this trade. We want to have this move quickly. But what we're going to do is we're going to create that order. And we're going to buy this one, the 100 strike. And I'll show you how we're going to do this. We're going to right-click with this, and we're going to buy custom with an OCO bracket. But we're going to do something a little different on this OCO bracket. So I want to get into the trade. Great. No problem. I want to get into the trade on this long option. Now, again, remember, this is going to cost a little bit. I mean, this is going to cost me, in this particular case, $1,260 per contract. So it's not necessarily cheap, but it's cheaper than shorting the stock. It's cheaper than buying the stock. But as we create this order, I'm going to go back to edit this, and we'll go back and edit this trade. So the first thing is I want to get out if this goes down to where I want it to go. So I'm going to make that a market order. And in fact, I'm going to make this next one a market order. Now, if I were to just leave it right there and I put that out and that were to fill, boom, it would just exit in this particular case, which is why it says plain market order may not be a part of an OCO group. What we're going to do is we're going to make a little conditional here. So I'm going to go back to that chart really quickly, and I'm going to say, look, the first conditional is, what if this goes down? So I'm going to say 74. So I'm going to come back to my trade tab right here, my order entry, and I'm going to use that little conditional. You see that little gear that pops up right here on the right-hand side. I'm going to click on that conditional, and it's going to pop up this pop-up right here, which says, sell this option, regardless of what the price is. That's what the market says, at the next available price, and do that if the price of the underlying stock, so if Shake Shack marks at or below, right? So this would be less than or equal to, and we said 74, right? So less than or equal to 74. 74. That's our trigger, $74 on the underlying stock. And I'm going to make that good till canceled so that I don't have to recreate that every day. Click on save. So there's the first part of our order. So in this particular case, as we're putting this order in, right, this is, again, going to be that trigger. Now, we're gonna do the OC order, and we're gonna come back and deal with this order to get into the trade. So the next one is the order to get out if it goes against us. So let me drop this down just so we can see it. We know that our exit to get out, or our order to get out if it goes against us, is this one right here. I'm going to make it 97 just for easy math. So if this goes up to 97, I want to get out. So we're going to bring our order back up again here. And we're going to make that order this one, good till canceled, and we're going to click on our gear icon, and we're going to bring up this display. Once again, that pop-up for our order rules with that little gear icon. Market order, good till canceled, symbol, method, mark at or above 97. 97. And that's going to be our order to exit, regardless of what the option is priced at that particular point. So we're basing the exit, we're basing the take profit exit and the stop exit both on the price of the stock doing something. Now, the other thing is we could make this a sell stop, or excuse me, we could make this a buy stop order if the price of the stock went down. But what we're going to do in this particular case is we're going to trigger this order to enter also based on that price movement below this particular level right here. So I'm going to call this 92. I'm actually going to go below 92 because it's at 92.66 right now. So I'm going to come back over here. We're going to open up this order and we're going to say, fine, we'll go to the gear icon and we'll bring up our order entry rules once again. And we're going to say, all right, I'm going to buy this long put option at a market order, whatever the price is, good till canceled, if Shake Shack marks at or below again. Now we're at or below again. In this case, we said, what did we say? 92? I think that was the number. But we can come back and change that if we need to. But 92, and then we'll click on save. Let me just look at where that was. Yeah, it was 92. We said 92. Okay. So here's our order. And if we click on confirm and send, we can kind of see what this looks like. It looks kind of complex at this particular point, but we're going to read through this so that we understand it. Buy one Shake Shack, 19 December expiration, 100 strike put at a market price, but only trigger that market price, that market order, if Shake Shack is at or below 92. And then sell that option if Shake Shack goes to or below 74, or sell it if Shake Shack goes to or above 97. So that's the range in which we're looking at this trade working. And so that's the order that we're going to create here. So let's kind of do this really quick. Before I fire this order off, I want to do two things. I want to come back over here to the edit page, and I want to just kind of play the what if game. So our first what if is, what if the price of the stock goes down to 74? What does this option become worth theoretically? So I'm going to go to my 19 December expiration. I'm going to change my layout from Delta, Theta, and Vega, and I'm going to change that to Theo, Price, and Mark. So what I want you to look at as we look at this calculation is I want you to look at the theoretical price. Let me just make sure that this is reset first. Let's reset this. Okay, there it is, reset. Okay, so now those two numbers should be, for all intents and purposes, pretty close to one another. So we're looking at this number right there, that's the theoretical price, and we're comparing it against the mark price, which is what it's currently trading at now. So we're going to play the what if game, and the what if game starts with, what if the price of the stock goes down from where it is now at 92.57? What if the price of that stock goes down to 74? So we know that that's going to be about a minus, what, $18 move? Whoops, $18 move? Minus 18. Puts us down right about 74. So you see what that option theoretically should be worth if the price gets down to that level, about $25.75. We paid $12 for it. So we essentially doubled our what we paid for the trade. So doubling something, that's 100% gain. So theoretically, if this does what we expect it to do, 100% gain to the downside. Okay, now let's play the what if game in the opposite direction. So we're going to reset this. Now, the other thing to think about is it would make that 20-point move to the downside, but it's not going to do it independent of implied volatility, and it's not going to do it independent of the passage of time. So we know that some time is going to pass, so let's kind of add that into the mix. Let's go out, say, for instance, to the middle of October, end portion of October, the 24th of October. So we know that that is going to eat away at a little bit of that profit as it goes forward. But at the same time, let's say that implied volatility goes up, because if the price of the stock's going down, likely implied volatility is going up. So let's go 10% to the upside. And that is going to add to our premium a little bit. So we changed the date, right? We changed the date, 10/24. We subtracted the price, and we added implied volatility. And that's what we've got so far. That's what we've got our option theoretically being worth at that level. Okay, so now let's play the same what if game. So the problem is, I'm going to reset this. Just we'll take it back to reset. Now, if the price of the stock goes up and it goes to, what did we say, 97. So that's about a $5 move to the upside from where it is. So let's do +5 to the upside, okay? And so we can see what that option is now going to be worth, theoretically, $9.74 if we go up. But again, that's probably not going to happen independent of price movement or of time passage. So we're going to go to, say, for instance, the, again, middle of October, and we're going to take a little bit of that time decay, and we can see what that time decay has done. And then if the price of the stock goes up, you know what's likely to happen to implied volatility is that implied volatility is likely to go down. So you can see what that option is going to be likely worth. So we're losing potentially half of the value of that option that we paid for it if the price of the stock goes up. Because remember, this is a long put, and we're taking advantage of that downside movement. So by doing this and by playing this what if game with a theoretical price calculator, we're kind of getting a sense of what this trade kind of shapes up to be. So this is about 2-to-1 reward to risk potential in this trade. We're looking at taking the trade off if the price of the stock goes up. Theoretically, the price of that option is going to be worth about $6.91, about $7. If it goes up and we get out on that stop, and if it goes down and does what we expect it to do, it's going to be worth about $25 to $27, theoretically. All of that can change, because remember, these are theoretical numbers. It even says it right here in the name, Theo price numbers. So kind of play with that. That's a great tool to kind of get a sense of how those options might behave. So we're going to go ahead and I'm going to kill that annotation. We're going to fire this order off, because the first thing that has to happen is the price of the stock has to go down below our support level. And so we're going to fire that order off. We're going to go confirm and send, read through that order, make sure that's what we want it to do. I'm going to put it in my market movers section, and we're going to fire that order off. Now, we've got to wait for that price to move for us to get into the trade. Again, that's kind of that waiting game. We're setting it up so that we're waiting for something to happen before we enter the trade, which is okay. All right. Now, let's take the other side of this equation. Let's take a long potential trade and look for the upside. Now, I happen to have one in my monitor tab. In fact, I've got a couple of them here that have been moving in our favor. And I thought, I was looking at this one, and I wanted to kind of pay attention to this one. We had looked at this, I think, before. Now, R1 says, what if it goes to 97 and then goes to 74? So if the price of the stock goes up to 97 and we get kicked out of the trade, and then the price of the stock goes down to 74, that would be frustrating. Yes, that would be frustrating. It happens. How many of you have ever entered a trade and it's gone against you, and then you got out of the trade and then it went the opposite direction? I have, quite often. So there's nothing that says we can't get back into the long put if we get kicked out of it at 97 and then goes all the way down to 74. But, the other side of that coin is, R1, we don't put in a stop order on the trade and we let that trade go, and maybe we goes to 97 and then goes down to 74, and great, we go, cool, yeah, that's okay. But maybe it doesn't go down again. It's going opposite the direction we want it to go. Yeah, exactly. Good idea, Paul. Yeah, it's happened to me quite often. So something to think about. Now, let's take the next discussion here. And this is one, yeah, it would be unfortunate. I don't mean to be flippant about it, but it happens, right? And you can't necessarily, certainly can't control something like that. You can't hedge against or balance against something like that happening all the time. But let's take a look at this one. This is a long call. So this is the 17th October. It's got 17 days to go until expiration. And it's actually been moving in our favor. So I wanted to take a look at this one in terms of a long position. So we've got this long call option. So I'm going to go over here to the chart. We're going to go to GE. And here's our long position. We're getting this little bit of a bull flag off of that level of support. The question is, that we would always ask in a situation like this is if we're looking at a position that has done, kind of that time factor, here's what's beginning to happen with this particular trade. We know is that, I'll grab my magic marker, that this time decay curve is now becoming a much bigger issue. And we're kind of at this point right here ahead of that expiration. We're at that point where that rate of time decay has really started to accelerate to the downside, meaning it's starting to eat away at our premium. So whatever gains that we've made in this option right here, we paid $18.90 for it, and it's now trading at $39. Whatever upward gain we're making in the price of the stock moving, we're losing more, not necessarily more, but the tug of war between directional gains and time decay losses is starting to go back the other direction in terms of time decay. So we've got to do a couple of things. We either close it out and say, cool, we made some money on the trade. Or we say, at this particular point, what if we were to roll it and continue this upward movement and just give ourselves more duration, more time in this particular case? So that was my thought process here in looking at this one, because if we go back to the chart and we look at this, we say, all right, look at what's going on. We've got a nice little bull flag here, and implied volatility has been going up. The price of the stock's been going up, and we've been getting a little bit of a bounce, and implied volatility has been going up as well. Cool. So this little bit of a bull flag bounce here gives us an opportunity to say, yeah, if I were to enter a new trade right now, that might be an opportunity to enter a new trade. In fact, we've got a close above or a trade above the high of the low day on this GE trade at the moment, today, right now. Now, that's not a recommendation. That's not a guarantee of anything, because it could turn around and could go down tomorrow or today, even in the next tick. But we're getting a little bit of a bounce at this particular point. So what we're going to do is we're going to roll this trade. We're going to roll this long option. So I'm going to go back to the monitor tab. And I'm going to say, all right, how far out do I want to roll this one? 17 October, 17 days to go until expiration. It's at the 260 strike. So let's go to the trade tab for GE and let's see where that one is. That's right down here. And let's see how deep in the money that one is. So I'm going to change my layout once again to Delta, Theta, and Vega. And that's about a 95 delta. Holy cow. So what's going on is this is behaving almost as if it were the underlying stock. So we're losing some of that leverage. So let's see if we can harvest a little bit of that gain that we've made and kind of put this in a position where we're able to take advantage of more of that duration. So we're going to roll from this October 17th, 95 delta, 260 strike. We're going to roll out for time and up in strike price. To see where we might go, we're going to close this option chain Yeah, so Vic asks a great question. Is there any advantage to rolling versus closing the trade and opening a new one, which is exactly what we're doing when we're rolling. We're just doing it all in one transaction to be convenient, right? It's a convenience factor more than anything else. So we're going to roll. I'm going to roll in this particular case. I could close down the other one, and oftentimes I will do this. I'll do this, in fact, in my trading index options webcast that I teach on Wednesdays. I will oftentimes, instead of rolling, close one leg or close one iteration of the trade and then open up a new one, just because I can talk through it. But you could do the same thing with a roll. Same thing here. We're going to do this as a roll. So I just want to kind of preview what that roll would look like. I'm going to go out to the 19 December expiration, 80 days to go until expiration, giving us an opportunity to continue to move higher. And I want to look for a call option that, it, once again, has a little bit of intrinsic value, but also has a little bit of leverage to it. So I'm going to actually land right here on the 280 strike. Fairly tight bid-ask spread, 45 cents in this case. That's okay. This is a pretty liquid stock, pretty liquid underlying stock. But that rolls me back out time-wise to 80 days to go until expiration, and up delta-wise to the 70 delta from the 95 delta. A little more leverage. We lose a little bit of intrinsic value, but at the same time, we're now back at a point where we have some leverage to maybe make a little bit better percentage gain. So let's go to the monitor tab and let's see if we can accomplish this. We're rolling to the 280 strike. Okay, so I'm going to right click on this one and I'm going to create a rolling order. And I'm just going to adjust this rolling order from here, because by default, the platform looks at rolling to the same strike and the next available expiration. But we know that we're not going to roll to the next available expiration. We're going to roll out to the 19 December expiration. That's this one right here. And if we were going to roll out to just to the 19 December expiration, our net debit's going to be $6.48. I don't want to pay more money for this trade. So I'm going to roll this strike price up a little bit, the one that I'm going to buy. We're going to roll that to the 280, which is going to be a little bit less. We're actually going to roll this for a little bit of a credit. Or in other words, we're booking $8.50 of theoretical profit gain in this particular trade for creating this roll, and it gives us duration and it gives us leverage. Cool, triple bonus, right? So I'm going to create this rolling order for an $8.45 credit. And I'm going to click on confirm and send. So here's the numbers. We're at the 17 October expiration 260 strike. So we're going to sell that one. And we're going to buy the 19 December 280 strike. And we're going to do that for a credit of $8.70. We're still going to be long the option. But we're doing it for a credit. We're rolling this for a credit. So click on confirm and send. Make sure that this is what we wanted to accomplish. One is to open, one is to close. Make sure that that's what we wanted to do, and we're going to put it back in that group. We were in the DC workshop. Okay, we were in that group. So I'm going to go ahead and I'm going to click on send, and we're going to fire that order off, and we'll see if that order fills for us. Now, now this is where, again, I'm going to say that rolling an option is not a magic wand. And sometimes you got to bump this a little bit just because it doesn't, it doesn't guarantee that you're going to get that trade to work. So we're going to, that's weird. Why is that keying off of that one? That's weird. Okay, anyway. So we're going to go ahead and we're going to just cancel replace this. We're going to bump this GE diagonal a little bit. We'll open that up. And we'll kind of bump this up a little bit so that we're not requiring as much of a credit to get this filled. And that gives the market maker a little bit of leeway. Now, this is paper money, so it's more often than not going to fill at the midpoint. So I'm going to go ahead and click on confirm and send, read through the order once again. We're going to put this in the DC workshop group, make sure that that's still what we want it to do. I'm going to click on send. And we got it. We sold it. We created that roll, that diagonal roll, essentially, for $8.40. So we booked that $8.40 of theoretical profit or theoretical gain in this particular case. And now we are long a 280 call instead of being long the 260 call. We're now long a 280 call with 80 days to go until expiration. And it's at $30.20, which was our cost on that trade That's our max theoretical loss now in this trade, $31.17. Now, again, we want to see the price of the stock continue to move higher, right? This is still directional. So we're going to go back to that chart. We're going to take a look. Is it continuing to move? Now, we could put a stop order on there like we did with the put option. We're not going to in this particular case because we're just going to simply let this continue to chew to the upside. Now, we could put a stop order on this, by defining a level at which we're getting out of the trade. What I am going to do on this, though, just from the standpoint of never having a trade that is really a set it and forget it, because this is never, trading options especially, never a set it and forget it perspective. But I'm going to define where that little gap is right there. And I'm going to say, look, right about here at the kind of that 286 level or so, I'm going to come in here and I'm going to right click and I'm going to create an alert. So rather than putting a stop order on here, I'm just going to create an alert that says if GE goes to or below 286.96, whatever that level was, send me a message, ring a bell, shoot up a flare, whatever it is, and set that alert so that I am alerted if that happens. Now, that being said, in this particular case, don't rely on alerts to get to you, because how many times have you had somebody send you a text message and they said they sent it and you never got it? That can happen. So don't rely on this. Attention must be paid. So R1 says, what are the commissions on the roll? It doesn't eliminate transaction costs. So whatever the transaction costs are to close it and then open another one are going to be the transaction costs for the roll. It's not going to eliminate the transaction costs, right? But yeah, you would be charged those transaction costs. It's not a magic wand to wave your magic wand and roll and eliminate any transaction costs. And it depends on the liquidity of the target, strike, and expiration in order for this to get filled. So 2 trades that we've done, a long put option and a long call option. We've rolled that long call option. Now, the sideways part of this trade, that's the thing. The discussion of this is long options, and long options are directional options. So if you want to learn about sideways trading options, I'm going to give you some choices. So when you come up here and you go to the Trader Talks webcast page and you type in sideways options, now you've got neutral option strategies. You've got things like covered calls, trading the trend, bullish and sideways, selecting an option strategy, choosing a strategy, lots of different ways that you can approach that sideways perspective. And those are some resources. Join us over there for those resources. Now, what I will do is I will go over here to this watch list. And let's see if I've got the corresponding scans still. Let's see where our scans are. Load scan query. Personal. Small cap weekly options, right there. Okay. So there's my small cap weekly options scan. And what I'll do is I will go ahead and I will share that with you. Now, remember, sharing scans, sharing watch lists, sharing any scripts, not guaranteed as to time or accuracy. Your mileage may vary. Those are simply for illustrative and educational purposes only. So my thanks to Connie Hill for helping out. My thanks to our great production team for helping out with this as well. I will also put that in the description page for this webcast so that those of you that are watching this on the recorded version can get it too. Thanks for being here with me and trading long options. We will see you guys again very soon. Take care, everybody. Bye-bye.